Hello, everybody, and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's guest is the CEO of Flying Nickel Mining. Their flagship Monago project is one of the world's largest high-grade open-pit optimized platinum nickel sulfide deposits. Somebody I always love talking to, it's John Lee. Welcome back to the show.
Good to be back, Jesse. Thanks for the invite.
Yeah, absolutely. And I want to start by getting your thoughts on the current state of the broad market and the economy before we dive specifically into nickel, platinum, precious metals, a bunch of other stuff. So, what are the themes and trends you're watching when it comes to the economy and markets that you think investors should be paying attention to?
We talked a bit about COVID, the pandemic pre-introduction prior to the recording. And that really kind of opened my eye on how the world really works. And I've been a student of the market for over 25 years and really started to understand the extent of how the market is quote unquote managed. I mean, you have some people that talk about the loss of the price discovery. And what I see here is it's not just pertaining to gold and silver, but I would probably venture to say that 80% of the volume that you see across literally all the markets are computerized and that are managed by the invisible hands. That would go for currencies, for example, Jesse. If you look at back in the days, remember the 2011 rally after the financial crisis. You had oil at over $100. Last time it happened, Aussie dollars and Canadian dollars were at a premium, substantial premium to the US dollar. And now all the currencies look alike, whether it's euros or Aussie dollar, Canadian dollars, and Canadian dollars long lost its peg on commodities per se. So all the currency are now subordinated to the dollar. And once the invisible hands say, dollar, go up, and all the other currencies, how low going to jump, right? And same, I think in many extents. So the currency is same with the interest rates. There's a discrepancies on how the inflation had rippled across the world. I mean, if US is high on inflation, and then Japan, the world's third or fourth largest economy, shouldn't experience something differently. But I was in Japan or other parts of Asia. Certainly, there's elements of inflation in the tune of 10, maybe 20% at the most, but definitely not to the extent of, say, Canada or parts of the United States. So there's a lot of different elements in play, and I would just, from what I've seen traveling across the world, 35 different countries, and I was in Croatia and your parts of the world last year, as well as Turkey, in Europe, and in Asia, in South America. I spent quite a bit of time in North America as well. Is that a lot of these markets are managed, and from where I see, as you know, I've always been a bull of the precious metals, because in the end it is money, and in order for the power that be to continue to exert influence over the media, over over different countries in talking up their stories, they have to be able to continue to print, right, to finance their stories. So the gold and silver prices are definitely managed, and that we have a big epiphany moment where gold surpassed 2,000, and that is I don't think we're ever going to look back below 2,000 again. So there's still a lot of upside from here, but overall, what I expect to see and what we see in the market is a lot higher interest rates, and the mixed equity markets. I also am a believer that the markets actually the power that be are busy sort of while putting out the sort of nonsensical stories about gender equalities and the definition of different genders and just the different distractions out there. They're actually purposely printing behind your back in buying the real assets, and they are the S&P 500. and that's why they've broken out to all-time high. There's a bit of mild correction going on in anticipation of fewer interest rates. I don't believe there's going to be more than maybe one interest rate cut because of the election season, but people are coming to recognition of that, and the fact that the 10-year and the 10-year and the 30-year that are actually our yields are lower than the 2-year. That just tells me that the market participants are still behind the curve in recognizing that the era of low rates are over, and that the guys that control the printing press can basically calibrate the rates to whatever levels they wish because they control the currency, and that it doesn't make any sense right now to have long dated bonds that are trading higher than, like, long yields need to be higher than short yields, right? That doesn't make sense right now. Just like 5 years ago when the yields are negative for the 2 years, and again, so that just tells me that we're not seeing the worst of yet in terms of higher rates to come, and that I think the end result is a lot more disturbance around the world, not necessarily result into a lower equity prices, because as I said, that there's other things at work regarding equity prices. But I am not very bullish of the housing market. I am not really bullish of a lot of things, and we're just gonna, the economies are going to continue to be to be cooling down over time, and it's just gonna be, the market in terms of commodities is gonna continue to be a struggle between what I call a destruction of demand and disruption of supplies. Jesse.
Excellent summary. I do want to pick your brain for a moment on the performance of both gold and silver. You're also the founder of Silver Elephant Mining, so you've got a lot of knowledge in that sector. What do you think are the main catalysts driving both metals right now? How high do you think we could go? Are we in for a long, sustained bull market? What are your thoughts on gold and silver here?
Well, in January, if you go to my Twitter, it's John Lee. If you just search John Lee Silver Elephant or John Lee Mining, you'll see my Twitter. It was pinned. In January, I said it is the best time to get in gold and silver. And back then, silver was just over $22 and gold was $18.50. And sure enough, and I also mentioned that it is time to harvest. The gold and silver will peak around March, and the equities will peak around April. So I am not that far behind. And then to tell the investors to sort of pocket their gains, at least take your original money off the table. And then by May, part of that is seasonality, and part of that is technical driven, because as prices are managed, the technical indicators are a lot more relevant, because the street can stay irrational longer than you can stay solvent. And as I talked about that since 1913, if you look at the price of a stamp, right, and just look at everything, the inflation has gone up multiple fold. And that the currency is depegged really since 1913, and the implicit peg is also, so explicit peg was removed in 1970, and so these are the two events that really accelerated the demise or the sort of the purchasing power of the dollar. And in order to continue the agenda of own nothing and be happy, and to continue to fight for the power that be to finance all of their different players and all the different things on the medias, on the corporate world. I mean, they're printed by S&P 500. They probably own around 70-80% of that. In order to tell the Facebook or the Microsofts on how they can continue to print out the narrative, they have to be able to control the different players. And in order to do that, they have to control the currency. If you look at gold, for example, there's been multiple times I hit that 2000 neckline, break head and shoulder. And the neckline is 2000. And the first time I hit it was 2010. And then 2016 and 2019 and 2024. So what you notice that the period of which the neckline is being challenged, right, it's gotten shorter and shorter. And lo and behold, the 2024 was the ultimate breakout of that neckline of 2000. And 2400 was my target, because if you look at the bottom of the cup and handle formation, the bottom of the handle was 1600. So if you look at it from 1600, and that was the 2019 pandemic, So if you look at the cup, if you look at the sort of the cup at 1600, and the neckline is the handle is 2000. So if you were to do if you do extrapolate onto the other side, then you see a $2,400 gold price. Silver is I think we come on the show to talk about silver. So temporarily, I think gold is hit a bit of a resistance level at 2,400. It doesn't seem to be mustering enough momentum to get past that. Soon as gold started to mirror or go opposite the strength of the dollar, then it's hitting a stop right now because the dollar is heavily controlled. So if gold sort of fall in line with the opposite of the dollar, then sort of the gold is going to be the gold is losing its momentum, its steam, and it's going to be consolidating again. Right, so let's stay for gold for a second, Jesse. Is that right now it's very clear to me that the power that be is going to take the dollar to 110. I think at 105 is brief stop, and it's gonna go back to 110 level, which is the pandemic level. And the weakness of the yen is broken out of 105. So not 105, 150. It can go to 200. Maybe unfathomable, but that's what the chart tells you. A 40-year chart. So continued weakness of the Japanese yen, which again doesn't make any sense. At an interest rate 0.25%, and it's a great time to visit Japan right now. I was there just a couple of months ago, and you could potentially see the dollar index at 110, which means a good entry point for gold again would be in the fall. Or maybe in late summer when the dollar challenges back to 110, it's going to take a bit of the breather. I don't think gold is going to go back to 22,000, maybe 2,200. I really don't know how low gold is going to go because this time what's fueling gold, as I mentioned before, is not speculative purchases, but the central bank buying and the big power that trying to stay away from the currencies and the digital currencies and all those mandates. So they're resorting to buying gold. On silver, again, silver is running out of steam. It had a shot at taking out 30. If it did, it could have gone to 50. But silver is a bit of a laggard to gold, and it's not as strong as I've seen. Part of that is the weakness of the base metals across the board, which we can talk about. And it doesn't seem like silver is going to make past 30 at this time around. So we're going to see a bit of consolidation right now, gold between 2,200 and 2,400. Even though the 200-day moving average is around 2,000, I don't think it's going to go there, but you never know in a thinly traded summer market. And for silver, the 200-day average is around 23. Seeing the sort of the violent movements in silver, just even today, silver is down about $1, 4%. So in a thinly traded market, I would not be surprised if silver were briefly touch on the 200-day moving average of 23. Just because of that industrial demand is creating a bit of a slack on the market for silver, and also that silver is a thinly traded market in the summer doldrum. You can see that silver price being managed to the $23 to $25 range. But going further though towards September, when the dollar hits about 110, that is your ideal entry point. And you don't really want to follow gold and silver sort of on the technical breakouts because there's been a lot of fake breakouts per se. So you want to follow really actually on the gold and the technical support level, gold and silver. So ideally, if you're getting a dollar at 110 and then gold and silver near the 200-day moving averages around $2,023, hopefully sometime in late summer or early September, that would be your ideal entry point. And from there on, gold is going to challenge 2,800 to 3,000. Nobody really knows how high it's going to go. You got to really follow the momentum and the volume. And that see how gold acts in defiant of a rising dollar, which is capable of doing as you see. And then also for silver, once it goes past 30, you just got to continue to see that strong momentum. You got to see volume, a lot of volume, and you got to see defiance of these metals in defiant of a rising dollar, which it did. I mean, gold went from 2,000 to 2,400. While the dollar index is going from 102 to 105. So it's capable of doing that, but right now it just seems to be running losing a bit of a sting at the moment.
So we were talking before hitting record as well about this narrative out there of a coming commodity super cycle which all commodities will benefit from. There's a discussion out there that we're going to see a rotation from overvalued tech stocks into hard assets, and that the whole commodities complex is going to benefit from that. But you pointed out that the rally in metals are not uniform thus far, and you see certain metals exceeding, some other commodities being left behind. You don't see it as an across the board commodities supercycle. Is that correct?
Yes, you're right. If you look at if there is a commodity super cycle, every time gold hit 2000 in the past, in this modern since year 2000, oil has taken out 100 over 100, and especially with the U.S. banning of the fracking, you should see oil well over 100 already if there's a resumption of the commodity super cycle. I mean, you can also make a case. Well, you see, copper, right? Dr. Copper is gauging the economy, but yet you're seeing other base metals like lead and zinc that are in the doldrum, as well as platinum, palladium. If you're seeing again resurgence of the economy recovery, then you should surely be seeing recoveries of the auto sectors, and now you're seeing auto production that are declining. So and then platinum, palladium are trading at multi-decade lows. So definitely you're seeing this diversion in metals. And right now, my thoughts are on a high level. I actually believe what Elon Musk is saying, that the world is entering into a depopulation crisis. And this is from what I witnessed traveling across the world, in parts of Asia, in Japan, in Canada. And that there are just not as many people as what I saw merely 3-4 years ago. Maybe they're at home, maybe they're not going out, maybe they're not eating as much, maybe they're not consuming as much. Well, it is the same results. Okay, if they're just not spending as much, it's no different from, say, they're just not there. And we are entering into, and that also a factor that you see, that you're not seeing silver outperforming, because typically silver is actually a proxy, or actually has a very positive correlation to the equity market. And if you're going to see a bit of froth in the economy and speculators coming in, if you're going to see the economy is overheating and commodities are in high demand, you should be seeing silver outperforming gold. But right now, in the last 3-4 years, silver to gold to silver ratio has been persistently on the high side, and even challenging the century mark in the high 90s, not even 3-4 months ago. That ratio is only been topped at that level only 3-4 times in history. So that's also telling you there is, even though people can keep talking about there's a new industrial demand for silver, etc., what I see is a laggard in the industrial demand for silver, and that's putting a lid on the silver. But I mean, silver is a very volatile market. It's not a very big market. It's over 1 billion ounces. That's $30 billion. So you can't really predict the future of the silver market. So I don't see that. I don't see sort of spillover and super commodity cycle and money come from NASDAQ. I want to just diverge for a second on NASDAQ. I studied the market like I said, I studied the market for over 20 years. There's always a bear market on the general equity market, the doom and gloom, and you can make a case about it, especially given the yields has gone up 3-4 times, and of course, if the risk-free interest rate is more than double, and the equity market need to the yield, the dividend need to double for the equity to stay at the current level, and if the dividend has stayed the same, that means by definition the valuation need to be halved, right? Because the PE ratio will be halved if the risk-free yields are double like they have right now. But yeah, you're seeing the equity making an all-time high. It doesn't make any sense whatsoever. The conclusion that I come up with is, as I mentioned to you earlier before the show, that you have invisible hands that are literally printing money, and they are printing money to buy the market. I mean, think about it, right? If nobody's watching the border, if Afghanistan can be $100 billion of arms left, I mean, if you have a incognizant and president and that's sitting at the helm, who's controlling the printing press? So The interesting analogy I want to share with you, Jesse, is, before I come on the show, I try to make it a layman's term, even though people say, oh, the printing press, whatever people say, nobody really pay attention to it. If you watch the movie or the YouTube, if you have a monkey, and if you feed the monkey, like you tell the monkey to scratch the monkey's head, and then monkey does what you said and give like a little grape, and then you ask the monkey to do like another different act, right? To sit, right? Or say hello or wave the hand. Okay, the monkey gets another grape. And all of a sudden you put the monkey's friend next to it, another monkey next to the cage. And then you tell the other monkey to wag the tail, and the monkey's friend, number two, wag the tail, and you give the monkey a banana. And the first monkey would see that and say, "Oh my God, what did you do? It's not fair, right?" And then you ask the monkey to wag the tail, and you give the monkey a grape. The monkey would take that grape and throw it away. The point I'm making is I think people are still very oblivious of what's happening, even though it's very clear for me to see what's happening, that the power that be are absolutely control the printing press. The invisible hands wealth are not measured in dollars. The dollars, the fiat currency, they are vouchers for the enslaved. And these are coupons. And with the advent of digital currency, they're going to also control where you buy it, when you buy it, and what you buy. And if you live in Canada, 60% or 70%, or even London, 70% of your rent, of your money going to paying the rent. Well, what is that definition? Jesse, what is that, right? And the rent and the food, and then you have nothing left. So you're subordinated. You're no different from we're going back to the pre-medieval era. And so it's very clear to me. And so what are the assets that are left remaining? It's S&P 500. So it's very clear to me if you look at the overall picture of who's the buying, who's the selling, right? So the power that be, they are buying S&P 500, and they are encouraging and fostering people to buy the cryptos, right? To buy the interest rates, because these are synthetic assets. They are not worth anything. They are manufactured. They are abstract, like the bonds. Remember back in the days, when I was a student, say you want to put 80% of the money in bonds and 20% in equity, right? Bonds, you give it a dollar in bonds, and they give you back $1, right? Plus yield. And then crypto again, right? You buy crypto of 20,000, you come back at 40,000. It's intangible. It's abstract. That's what they want you to buy. And what they don't want you to buy, number one, is gold and silver. That's the crypto. Number two things they don't want you to buy is equity, because equities are assets, and that's how they're measured their wealth with, not the voucher system. And so going back to you talking about they would never buy commodities, because that's the game over, right? It's akin to if you're cooking something like a Chinese, you're cooking something and you drop like gold and silver. If they go to the cryptos level, then this game over. So they would never. I would never see the rotation from gold and from the Nasdaq, the equity market, the participant of the equity market into commodities, and just as a test, like we're hiring people in marketing and in digital marketing in different facets in accounting and legal. I am not aware of a single person that participate in the S&P 500. These are from the Gen Zs, the millennials, the people my age. People are older than me, in their 60s and 70s. I'm 50. None of the people I know are participants of the equity market. That's telling you something. Well, if people are not buying, who is buying, right? So again, that's a telltale sign that we're into very interesting signs. I don't see that spill over into commodities. In short, again, I think summarize that we're seeing a demand destruction because of the depopulation that's happening. I would not be surprised to see right now the world is less than 5 billion people instead of 8 billion. I don't think there's any concerted concrete study to support the thesis there are still 8 billion people. So from that regard, we're just not going to see a lot of. I think we've seen the apex of the crazy times that we're seeing before COVID, and it's unfortunate, but we're just going to see a continued cool down of the economy. You're going to see a laggard demand, industrial demand of metals and commodities across the board, and you're seeing what you're seeing is outperformance of of gold and precious metals, which is a store of value, a savings, over sort of industrial commodities in oil and in other base metals. And the reason copper is outperforming as a base metal because China does not produce copper, so they're being hoarded by the Chinese as a strategic metal. But China produced silver, China produced lead and zinc, so that's why you're not seeing that outpacing of rallies in these base metals.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.